Ross Gerber is President and CEO of Gerber Kawasaki Wealth and Investment Management. And it's great to see you, Ross. Thanks for the time.
Yeah, thanks for having me.
First of all, I guess, what's your biggest takeaway from what was probably the most important data point of the week, the inflation reading?
Well, it's more of the same, which is inflation is well under control and moving lower. And really what's really pushing most of the inflation at this point is really just the cost of living, shelter. And so when you actually look at everything other than your rent, it's basically going down or staying the same. So this is a really good thing ultimately for people across the world because we don't want inflation and we don't want really high interest rates. So now the Fed has plenty of room to lower rates from 5.5% on down. So, it's really just how quickly they're going to move rates down is really now the question to what is a more reasonable, business environment for all. So this is a fundamentally positive thing for all assets, including real estate.
Okay, well, let's dive into some of those areas you're going to be watching that could be beneficiaries from a lower interest rate environment. What are the kinds of investments you'd be watching?
Well, obviously, the most interest rate sensitive, investments are really real estate. And so that's one of people's biggest purchases. So if you think about buying a home, it just gets cheaper to buy a home because rates go down. Or, for example, a car gets cheaper just because rates go down, or your credit card bills or your equity lines, for example, if you want to remodel your house. So it puts money in people's pockets that ultimately end up being reinvested in real estate some way or another. And also, just the value of real estate goes up based off what rates are. So if rates go down, the value of real estate kind of goes up. So we really like stocks like Lennar, which are a home builder, or Home Depot, which just reported soft earnings, but it shows what the potential is for growth now that rates might come lower.
And what about, Blackstone is another company, for example, that is very determined when it comes to real estate assets. They're a private equity player, but they've been expanding their business here in Canada, acquiring real estate assets as well. Would it be the same principles on the rate story with a business like that, or is it something different?
Well, I would say it's even almost like a double whammy for a positive for Blackstone, because they also borrow money for a lot of their deals as well. So a lot of their real estate has come under pressure in their main funds and their mortgage funds. So this immediately alleviates some of the pressure of being able to refinance, hopefully at lower rates than we're seeing today. And then on the other side of the coin, it gives them more ability to exit markets at higher multiples for their private equity, and the value of their real estate, which they do own, just based off the yield, will stabilize in value or potentially increase. So Blackstone has a lot of positive things that come out of lower rates, and they've always been aggressive during times of distress. So a lot of times they can realize those gains in the next couple years. So we're very bullish on these kind of companies over the next 3 to 5 years.
Okay, let's dig into something that people will describe in general terms, which is it gives you a sense of the kind of business that might be at the center of it, but it's still kind of vague. It's the idea of looking for value in the market. We've heard it a million times before, but like as an investor, if you're looking for value in this market right now, are there any good examples of investments?
Yeah, one of the things that is kind of confounded me a little bit is, entertainment companies got a big boost when everybody went back to the theme parks and the casinos and traveling and people did it with like a vengeance, 2 years ago and a year ago. And now that's like normalized. So there's been a little bit of this like concern on really great opportunities like MGM Resorts and Walt Disney Corporation, because they grew so quickly their experience as part of the business over the last 2 years, and now it's kind of stabilized. But people aren't paying attention to the other parts of their business that are doing very well. So we see, 15 times forward earnings for MGM and Disney are two top holdings at my firm for my clients and also in my fund GK. And I just find their valuations incredibly compelling because both of them have an online operation that is basically not being valued in the stock. With Disney, it's Disney Plus and Hulu. And, if you look at the value of Netflix at $260 billion, which is almost twice that of Disney as a whole, they they essentially give no value to these streamers. And then with MGM, they have an online gambling business that isn't quite profitable yet, but on the way to, and is becoming bigger and bigger by the day, but yet there's no value assigned to MGM for these businesses. So what we see is that these online businesses will become profitable, and then investors will realize that these valuations don't make any sense for iconic brands in, sort of like you can't really compete with these companies. So they have great moats and they're wonderfully managed. So I think it's a great opportunity for investors.
I think there are also two examples of companies that have a sizable exposure in a market like China. And so there's constant questions in the market right now around what the economic picture there looks like. Does that factor into your analysis on these businesses?
And I do think that's been actually valued into these stocks. But I'll give you an example. We've seen good numbers from Disney and MGM from their China operations. MGM actually had 30+% growth in their China operations, because remember, they were behind us a couple of years with the COVID opening, and it's been a much slower process. They haven't stimulated their economy like the US did. So the Chinese consumer is definitely constrained, and we've seen, bankruptcies, real estate problems. So that's an issue. But I think for entertainment companies, that's something China needs very much so to, remember, people like to be distracted during times of distress. These are almost like, a little, they're not recession resistant, but people want to go see a Disney movie. And remember, Disney got their movie, Deadpool into China, which was pretty impressive. And so people went and saw the movie, So I think that entertainment is going to still play an important role and be a growth business for China, because quite frankly, China is one of the most repressive, boring places in the world for its size, and it's, what a great potential this country has if it wasn't so poorly led with these sort of communist authoritarian ideas. So the bottom line is, these are core businesses that China needs to entertain their people.